So in the last class, we started talking about this last section on open economy macroeconomics. I think the main economic concept that we covered was this idea that a country's flow of goods and services across borders, as measured by net exports or the trade balance, had to kind of perfectly offset or match its flows of capital assets across borders, what we call net capital outflow. All right, that's a major idea. We worked through some examples of that to illustrate why that property has to hold. And then towards the end of class, we started talking about the prices of these international transactions, which we call exchange rates. There are two types of exchange rates that you need to know about, nominal versus real. And I think we're going to cover the real exchange rate today, and we covered the nominal exchange rate in the last class. So let me do a quick review question with you guys. This is the first one. I want you to explain to me whether each of the following groups would be happy or unhappy if the US dollar appreciated. Now, just remember, when we talk about an appreciation or a depreciation of the US dollar, we're talking about a rising exchange rate versus a lowering exchange rate, a falling exchange rate. And we measure the exchange rate as units of foreign currency per unit of domestic currency, that is per US dollar. So let's try the first one here. A Dutch pension fund that holds US government bonds. Would that pension fund be happy or unhappy if the US dollar appreciated? What do you think? Wyatt? Yeah, so if a foreign pension fund purchases US government bonds, how does the US government pay back the principal and interest on those bonds in terms of US dollars, right? And if the US dollar is appreciating relative to other currencies, then this Dutch pension fund is going to then be able to buy back a larger number of Dutch guilders, right? And so a pension fund that invests in a foreign country whose currency is appreciating is going to benefit from that. Very good. How about US manufacturing industries? Would they be happy or unhappy at a strengthening dollar or an appreciating exchange rate? Matt? He doesn't know actually. That's all right. He thought he knew and then he wasn't quite sure. Sean? Why? Yes, yes. So a strengthening dollar means that potential foreign customers who would be buying goods from US manufacturing industries are going to face higher domestic prices for US goods, right? And so this is one of the reasons why US industries are always worried when the dollar strengthens, because it makes their products less competitive on global markets. Sort of thought that was the ballpark it was in? Yeah. That's a very good, that's a good point. So if you want to look at it from the view of not the value of the firm's output or the cost of the output, but the prices of its imports or its inputs, if it's shipping them in from foreign countries, then that would actually be helpful. That's an example of one, Matt, where if you explained that like that on the exam, I'd probably give you full credit because I think that's correct. How about C, Australian tourists planning a trip to the US? Would they be happy or unhappy by a stronger dollar? Wyatt? All of a sudden, US tourism gets more expensive, right? If you're an Australian person, you've got a bunch of Aussie dollars and the US dollar now strengthens, your Aussie dollars don't swap for as many US dollars, right? And so if you want to travel to the United States, it's then going to become more expensive for you, right? So an Australian tourist would be unhappy. What about an American firm that is trying to purchase property overseas? Would it be happy or unhappy at the thought of a appreciating US dollar? Sam? Why? That's right. So real estate prices effectively fall for this firm, right? Because the dollar is strengthening relative to whatever foreign currency that they would have to purchase the real estate in, right? Very good. Okay. All right, so let's go through a discussion now about the real exchange rate, and in particular, how it differs from the simpler concept of a nominal exchange rate. So first, we'll start with just the basic definition. The real exchange rate is the rate at which goods and services of one country swap for similar, if not identical, goods and services of another country. Okay, so you'll notice here that really the only difference between the definition of the nominal exchange rate versus the real exchange rate is that the nominal exchange rate is the rate at which currencies between two countries swap, right? Whereas the real exchange rate is the rate at which goods from one country would swap for goods from another country, right? If you were to go to the store, to the wine store, and find that a bottle of French wine, a Bordeaux, let's say, costs twice as much as a bottle of red wine from, let's say, Napa Valley here in the United States, then what would the real exchange rate be? It would be 1/2 of a bottle of French wine swaps per bottle of US wine, right? Now, just like nominal exchange rates, in this class, we're going to express the real exchange rate in terms of units of the foreign good per unit of the domestic good or the US good. So number of foreign bottles of wine per bottle of US wine. Now, it turns out that there is a very useful formula that links or shows the relationship between the real exchange rate and the nominal exchange rate that you'll want to apply in these situations. And it's the following. The real exchange rate is defined as the nominal exchange rate, which is this variable E, times the domestic price, which I'll just call P, divided by the foreign price, which we'll call P star. Okay, so the domestic price for the US is, of course, expressed in US dollars, and the foreign price then is written in terms of units of foreign currency. If you multiply that ratio times the nominal exchange rate, the currency signs cancel out of that operation, and you're left with just number of units of foreign goods that swap per unit of domestic goods. Okay, now that's kind of just theoretical, and you do need to understand the formula, but let's work through a straightforward example to illustrate this idea, all right? Here's the one that I'm going to give you. A Big Mac from McDonald's in the United States costs $5.67. Okay, that's the average Big Mac price in the United States. It currently sells for 390 yen in Japan. So we've got a US McDonald's Big Mac and a Japanese McDonald's Big Mac. The exchange rate between the US dollar and the yen, I believe, is currently around 103 yen per dollar, okay? Given this information, let's go ahead and calculate then the real exchange rate. That is the rate at which Japanese Big Macs swap per US Big Mac, okay? Now, it's really easy to do. We can apply the formula, and it basically has just two kind of logical steps, okay? If you want to compare the rate at which a good from one country trades or swaps with a good from a similar good from another country, what you have to do is you have to convert the prices of these two goods into a common currency, and then you can compare the prices. That's how the real exchange rate formula works. So what you do first is you take the domestic US dollar price of the Big Mac and multiply it times the nominal exchange rate, E, okay? And so we have 103 yen per dollar times $5.67 per US Big Mac. Now you'll notice here that in this product, the dollar signs are going to cancel, right? 103 yen per US dollars times $5.67 per US Big Mac. The dollar signs cancel here, and what we're left with then is 584 yen per US Big Mac. In other words, the number of dollars it takes to purchase a US Big Mac after converting to Japanese currency is 584 yen, okay? The second step of the formula then, we can now compare the US Big Mac price in terms of yen to the Japanese Big Mac price in terms of yen by simply dividing one by the other. And that gives us what the real exchange rate is. It would be 584 yen per US Big Mac divided by the price of a Big Mac in Japan, 390 yen per Japanese Big Macs. The currency signs will cancel out of that ratio, and we're left with 1.5 Japanese Big Macs per US Big Mac, right? That's what the real exchange rate tells us intuitively, or that's how we interpret it. It's the rate at which goods from one country swap for identical or at least very similar goods from another country. All right, so essentially the way we interpret this then, the way I want you guys to think about it is that the amount of dollars that are needed to purchase one Big Mac in the United States will actually purchase 1.5 Big Macs in Japan, right? And so in this case, where are Big Macs more expensive, in the US or in Japan, relatively speaking? Where are Big Macs more expensive, Sean? In the US, right? Anytime the real exchange rate is above 1, then domestic goods are more expensive compared to similar foreign goods. If the real exchange rate falls below 1, it's the other way around. Foreign goods are more expensive and domestic goods are relatively cheaper. Make sense? All right, why don't you guys do this one? I'll give you like a couple minutes. It's the same basic exercise, but this is an important concept. I promise it will be on your final exam in some form or fashion. So take a couple of minutes to compute the real exchange rate in this case. So we're just changing the good in question. We've got a Starbucks latte in the US is $3. A Starbucks latte in Mexico is 90 pesos, and the exchange rate is 22 pesos per dollar. What is the peso price of a US latte? And then calculate the real exchange rate between the US latte versus a Mexican latte. And there should be space, I believe, on the next slide to answer that. Okay, any answers for part A? What is the price of a US latte expressed in pesos? Anybody from over here want to venture a guess? No? Fourth row? Sorry, say again? Yeah, 66 pesos per US latte, right? You just multiply the nominal exchange rate times the domestic price of a latte. And then what is the real exchange rate in this case? You just divide 66 pesos per US latte by 90 pesos per Mexican latte, and you get 0.73. Is that the answer you got? 0.73? Okay. Yeah, so unlike the Big Mac example, here the amount of US dollars it takes to purchase a Starbucks latte in the United States only purchases about 3/4 of a latte in Mexico once you convert your US dollars into Mexican pesos, right? So in this case, lattes are going to be more expensive in Mexico, right? They're going to be relatively cheaper in the United States. Okay, questions then about how to execute that when you guys comfortable with the formula? It makes kind of intuitive sense. All right. All right, so the examples that we've worked through here are useful because they provide some insight into how or what the real exchange rate is actually measuring. But they're very, very simple examples in the sense that they show us how a particular good, one particular good from one country swaps with the same type of good from another country, okay? Unfortunately, a lot of times what policymakers need to understand is not just the price, the relative price of a single good from one country to the next, but rather how the prices of a whole basket of consumer goods and services compares to the cost of that same type of basket of goods and services in another country. All right, how do we properly measure the real exchange rate then when there are many goods that we consume, not just Big Macs, but also lattes and everything else that we buy and consume, okay? Well, it's pretty straightforward. What you want to do is instead of using the price of an individual good, like a Big Mac or a latte, you would substitute for that variable the price of a whole basket of goods and services as measured by something like the Consumer Price Index or the GDP deflator, something like that, right? So if we take the price level in the US as reflected by, let's say, the US CPI, and the foreign price level, let's say as the Japanese version of the Consumer Price Index, then the real exchange rate would simply be the nominal exchange rate between the yen and the dollar times the US CPI divided by the Japanese CPI. That number, that real exchange rate number then, is going to tell us the rate at which a whole basket of consumer goods and services swaps with a similar basket of goods and services in another country, in Japan in this case, right? The real exchange rate here would be the price of a domestic basket of goods relative to the price of a similar foreign basket of goods, measured in units of the foreign currency. Let me stay on this theme of the real exchange rate for just a few more moments here. If the real exchange rate is appreciating, that is, it's rising over time, for a given nominal exchange rate, what does that mean about the ratio then of the domestic price to the foreign price? So if we see that the real exchange rate is appreciating, then for a given nominal exchange rate, that means prices domestically are rising relative to prices abroad, right? So domestic goods prices are becoming more expensive relative to foreign goods and services. Alternatively, if the real exchange rate is falling, then it's the other way, right? In that case, foreign prices are rising faster or relative to domestic prices. Let me ask you this question, and I don't exactly have this in the slides, but I think it's important to know. What do you imagine is the relationship between a country's net exports, that is its trade balance, and the real exchange rate? In other words, let's suppose that the US real exchange rate was appreciating. What do you think would happen to our net exports? That is our exports minus our imports. John, why? Right, so if the real exchange rate is appreciating, meaning that domestic prices are rising relative to foreign prices, our goods start to look more expensive. That means the rest of the world doesn't want to buy as much from us. So our exports decline. But on top of that, Sean, the rest of the world's goods look more attractive to us. So we want to import more from the rest of the world. And so net exports, or the trade balance, would probably fall. If the real exchange rate depreciated, we would expect the other thing to happen, that net exports or the trade balance to rise, okay? So just try to remember that there's probably an inverse or a negative relationship between a country's net exports and its real exchange rate from one country to the next. Okay, you guys have any questions then about real exchange rates? Make sense? All right. So let me move on now to, I guess, the last little topic of the course, and that is on developing a theory or a simple model of how exchange rates are determined over time. If you guys went out and took a look at real data over time of nominal exchange rates from the US to any of our trading partners like Canada or the Euro area or Japan, you're going to notice that the nominal exchange rate is not steady. That over periods of months and years, the nominal exchange rate might appreciate, and then for a period of time, it might depreciate. That there are long-run kind of swings in the nominal exchange rate. It fluctuates from one year to the next. What is it that explains these fluctuations? Why do exchange rates appreciate and depreciate over time? What factors are driving those changes? All right, we want to try in this last section of the course now to try to put together a very simple economic model that helps us understand why exchange rates move the way they do, why we see these appreciations versus depreciations over time. Now look, macroeconomists have developed any number of theories about how exchange rates are determined, okay? I'm not going to presume to talk about all of them. We're going to just talk about the simplest one in this class, since this is a principles class after all. And the model that we're going to talk about is based on, or the theory that we're going to discuss is based on changes in the price level or the prices of goods and services across countries, okay? This theory, and I'll get more into this on the next slide, has kind of a complicated name. It's called purchasing power parity, or PPP for short. I'm going to define it formally on the next slide. But for now, I want to begin talking about the theory of purchasing power parity by explaining that it's really just based on a very powerful microeconomic concept that I think is going to have a lot of intuitive appeal to you. It should make sense. And that concept is what we call the law of one price, okay? Now, what is the law of one price? This is the idea or the law that says identical goods should sell for the same price in all markets. So if you have two different markets that are selling the same good, then the law of one price tells us that in equilibrium, the price should be the same in both of these markets. All right, now instead of talking about this theoretically, let's just work through a specific example, and then we will apply this idea to international markets and the exchange rate. Okay, so here's the example I'm going to use. Let's suppose that coffee is selling for $4 a pound in Seattle, and it's a pretty competitive market locally in Seattle. The same type of coffee is selling for $5 a pound in Boston, okay? And again, within the Boston market, it's pretty competitive, okay? We're also going to assume, just to make things as easy as possible, that coffee can be transported costlessly between Seattle and Boston. You could buy it in Boston and sell it in Seattle, or vice versa, and that adds no additional costs to the sales, okay? Now, given this setup, we're going to see here that there's this opportunity for what's called arbitrage. Okay, have you guys heard of this term before, arbitrage? It's usually referenced in financial transactions. Okay, when you want to try to buy a stock for a low price and sell it for a high price, you're trying to arbitrage by maximizing the difference between a low price that you buy and a high price at which you sell, okay? Well, we can apply that same concept to this little example. And we see here that there is a potential for entrepreneurs, for people who want to make a positive profit, to arbitrage by buying coffee in the market that has the lower price and turning around and selling it in the market, since it's an identical good, in the market that has the higher price, right? Matt, for each pound of coffee you buy in Seattle and you turn around and sell in Boston, you're going to be able to make $1 of profit, okay? That's what we call arbitrage. Well, the question is, how long would Matt be able to exploit those profit or arbitrage opportunities? To illustrate this, let me switch over to the document camera here really just quickly. And again, I apologize, I don't have this in the slide, so you may want to draw this in the margin or on a separate sheet of paper. But here's the kind of the baseline situation that I've described in the slide, okay? Imagine we have two markets for coffee here. We have a market in Seattle and a market in Boston. And what I told you was that the current price in Seattle is $4 a pound. That means that the intersection of demand and supply, if we believe in the supply and demand model, should be at $4 per pound in Seattle, but the intersection of demand and supply should be at $5 per pound in Boston, okay? Now, what are profit-making arbitrageurs going to do in this situation? They're going to want to purchase coffee in Seattle at $4 a pound, transport it to the Boston market and sell it there at $5 a pound, thereby making $1 of profit for every transaction, okay? Now, how would this change then the equilibrium of this dual market? If lots of people, not just Matt, but other smart entrepreneurs, were to attempt to buy more and more coffee in Seattle and sell it over here in Boston, what do you imagine happens to demand versus supply in those two particular markets? Sean? As more people seek these profit opportunities, the demand, I agree with you, Sean, that the demand for Seattle will increase, okay? Thereby pushing up the equilibrium price somewhere between $4 and $5, right? But every time this happens, what happens over here in the Boston market? Because these entrepreneurs, these arbitrageurs, I don't know if I'm making up that word or not, would start to increase the supply in the Boston market, shifting the supply to the right. Therefore, what is happening to market equilibrium prices in Boston? They are shrinking. That arbitrage activity will continue to take place as long as people can realize a positive profit. So the demand in Seattle should shift to the right. The supply in Boston should shift to the right until the point at which the prices in these two markets are equalized. And only at that point are there no longer going to be any of these additional profit opportunities. That's what we call the law of one price. When you have identical goods selling in two different markets, and they can be costlessly transported from one to the other, we should not observe different prices in equilibrium, because that means people are leaving unrealized profits on the table, right? That's what we mean by arbitrage, and that's the example I've given here about the law of one price. Arbitrage will drive up the price in Seattle and drive down the price in Boston until they are equalized. That is, until all of these profit opportunities go away. I think that's a fairly straightforward microeconomic concept. Now, what we want to do is apply this same idea to international markets to help us understand why exchange rates behave the way they do. So how can we apply this idea or concept of the law of one price then to international markets? Well, let's think about this for a second. If a dollar can buy more coffee in the United States than it can in Japan, then entrepreneurs could realize a profit by buying coffee in the United States and turning around and selling it in Japan, just like our previous example illustrates. But what is going to happen in that situation? The more coffee that is purchased in the United States and that is shipped abroad, that's going to boost export demand in the United States and therefore drive up coffee prices in the US. The more that product is sold in Japan, the more import supply is going to be increased in Japan, which will tend to drive down coffee prices in Japan. And so for the exact same reason here, we see that prices should be equalized in these two distinct markets. They're just international markets in this case, because of the law of one price. So in the long run, I guess what I'm trying to say here is that US currency should be able to buy the same amount of a good regardless of where that product is sold, right? If coffee costs $5 a pound in the United States, then that same $5 should be able to purchase a pound of coffee in Japan once you convert your $5 into Japanese yen, okay? The theory of purchasing power parity is derived from this idea of the law of one price applied to international markets, okay? It says that it's a theory of exchange rates whereby a unit of any currency should be able to buy the same quantity of goods and services in all countries, okay? Now, what does the word parity mean? You guys heard of that term before? What's parity mean? Kind of like equality or balance, right? The reason this is called purchasing power parity is because it's a model that suggests that currency should have equal real value, that is equal purchasing power, no matter what country the product is purchased in, all right? That's the idea of the theory of PPP, and it's based on this law of one price. Now, the big implication here is then that the nominal exchange rate, if you believe in the theory of purchasing power parity, the implication then is that the nominal exchange rate is what should adjust then to equalize the price of a basket of goods across countries. If a pound of coffee should cost the same in the United States that it does in Japan, then the nominal exchange rate between the yen and the US dollar should adjust in the long run to make the prices of coffee across the two countries the same. right? In other words, again, if it takes $5 to buy a pound of coffee in the US, then the exchange rate should adjust so that however much you can convert your $5 into yen into, let's say it's 500 yen, that a pound of coffee should cost exactly 500 yen in Japan, right? You should not be able to make money by buying coffee in one country and selling it in the other. Okay, that's the key implication then of the law of one price applied to these international markets. So let's see here. Let's go back. Let's try to illustrate this point a little bit more by going back to our example of a Big Mac. Okay, so instead of a basket of goods and services, let's just assume that the only good that we are actually interested in consuming is a McDonald's Big Mac. Okay, the theory of purchasing power parity has a very powerful implication about how the nominal exchange rate should be determined. Okay, here the price level is just going to be the price of a US Big Mac in terms of dollars, right? $5.67, whatever it is. P star then is the price of a Big Mac in Japan expressed in yen. And again, E is the nominal exchange rate between the US and the yen. What does the theory of purchasing power parity tell us? What does it predict? According to PPP, the price of a US Big Mac should be the same as the price of a Japanese Big Mac once you convert your US dollars into Japanese yen, right? So you take the price of the US Big Mac, multiply it by the nominal exchange rate, and what does that tell you? That tells you how many yen it takes to buy a US Big Mac. That should be exactly equal to the number of yen it takes to purchase a Japanese Big Mac, that is P star, the foreign price, okay? That's the price of the US Big Mac in yen. This is the price of the Japanese Big Mac in yen, right? This is the law of one price. The domestic price should be the same as the foreign price once we've converted into a common currency. So what does this then imply about the nominal exchange rate? Well, all you got to do is solve this equation for the nominal exchange rate. And what do we see? That according to the theory of purchasing power parity, the nominal exchange rate between two countries should just be the foreign price divided by whatever the domestic price is, right? So over time, then what causes the exchange rates to fluctuate would be any change in the foreign price relative to the domestic price. Wyatt, did you have a question? Well, only for countries that have fixed their exchange rate or have pegged their exchange rate to the yen. Just because the US dollar fluctuates relative to the yen doesn't necessarily mean it's going to change relative to a totally different currency. But for countries that have pegged their exchange rate to whatever the yen is, or alternatively for countries that are economically very closely tied to Japan, where their currency value is impacted a lot by the yen, then those things could change. But no, these calculations are just one country to the next in general. Before we go on to the next slide here, do you guys see, what does this theory of purchasing power parity imply about the real exchange rate? In this example, what would the real exchange rate be? Hopefully this is just kind of intuitive. Purchasing power parity says that currency should purchase the same amount of goods in any country once you've swapped domestic currency for foreign currency. It should be equal to 1, right? What is the real exchange rate? It's the nominal exchange rate times the domestic price divided by the foreign price. In that case, we would have that the real exchange rate would be equal to 1, right? So what the theory of PPP says is that the real exchange rate should be equal to 1, which makes sense, right? In that case, domestic goods cost the same as foreign goods in terms of the rate at which the goods swap for goods. That's another way of thinking about or verifying the law of one price. Okay, does everybody understand where this formula came from? So just to emphasize this a little bit more, okay, I don't want you guys to get confused about this. The formula for the real exchange rate that I showed you guys earlier, which is E times P divided by P star, that's how we define the real exchange rate. That's the definition of it. You can always calculate the real exchange rate using that formula. This equation here, which says that the nominal exchange rate is the foreign price divided by the domestic price, that's not a definition. This is the result of a particular economic model or theory called purchasing power parity. It's an equilibrium condition, meaning that if you actually go out and look at data on exchange rates, it's not always going to be equal to whatever the foreign price divided by the domestic price is. Okay, in fact, there's a lot of reasons why it can be far from that particular ratio in the real world. This is just the prediction of a particular model. So don't get confused about that, right? Just like the supply and demand model says that price should balance supply and demand, that doesn't necessarily mean that the prices we observe in the real world are always equilibrium prices, okay? The exchange rates that we observe between two countries don't always balance foreign and domestic prices in the same way. All right. I think that the key implication then of the theory of purchasing power parity that tells us something about how nominal exchange rates ought to behave over time is that it implies that the nominal exchange rate between two countries should equal the ratio of the foreign price to the domestic price, okay? So what that means then is that what is going to cause exchange rates to move up or down over time would be anything that causes foreign prices to change relative to domestic prices, okay? In particular, if the two countries that we're talking about, let's say the US versus Japan, have very different inflation rates, or if those inflation rates change over time, that should cause changes in the nominal exchange rate. All right, let's go through this to illustrate this point, okay? What if I told you that inflation has been higher in Japan than in the US, and that Japanese inflation is growing compared to US inflation? What might that imply then about the nominal exchange rate? Well, if Japanese inflation is higher than US inflation, then that means that foreign prices are rising faster than domestic prices, right? In other words, this ratio of the foreign price to the domestic price is getting bigger and bigger and bigger, right? Which then would cause the nominal exchange rate to appreciate. Does that make sense? So as Japanese inflation rises compared to US inflation, then Japanese currency is becoming less and less valuable. It purchases fewer and fewer goods and services, including units of US currency. In other words, the US dollar would then get stronger or appreciate relative to the yen. All right, that's one of the big implications then of this model. Let me ask the reverse question. What if inflation is higher in the US than it is in Japan? In other words, the price level is rising faster in the US than the price level in Japan. Then what's happening to the ratio between foreign and domestic prices over time? It would be shrinking. And the nominal exchange rate then would also be shrinking. So if US inflation were high, then that means the US dollar is losing value. It purchases fewer and fewer goods and services. It therefore also purchases fewer units of Japanese currency. And that's going to make the US dollar weaker relative to Japan. You guys see that? That really is the key insight of this model. is that what it's telling us is that the reason why we see these kind of long run changes in exchange rates from one country to the next is because countries tend to have different rates of inflation. High inflationary countries tend to have weakening currencies. Low inflation countries will have stronger or appreciating exchange rate. Let me show you guys a picture with some actual data to help hopefully will reiterate this point. So we've got several countries on this scatter plot. Each one of these blue little squares shows a country, and it graphs the average annual rate of CPI inflation on the horizontal axis and the average annual depreciation of that country's currency relative to the US dollar on the vertical axis. The data were gathered here from the decade 1993 to 2003. Now, let me also point out the numbers are on a logarithmic scale, okay? I don't want that to confuse any of you guys, but hopefully you remember this from your math class. Anytime you have a logarithm of something that is less than 1, then the variable is negative, right? So on this log scale, a country like Kenya would have positive inflation, but a country like Japan, since the log is less than 1, would have negative inflation or deflation, right? And that makes sense because certainly during the 1990s, Japan was having falling prices. Japan has had deflation for many years now. This shows average depreciation relative to the dollar. So again, the higher the number, the more this country's currency weakened relative to the US dollar. That is, the stronger the US dollar became. Anything less than 1 would be the opposite. That means the foreign currency was strengthening relative to the US dollar. What do you see as the relationship here between high inflation countries and the exchange rate? The higher the inflation rate, countries like Ukraine, Brazil, Romania, were also the same countries whose currency depreciated the most relative to the dollar. That is, it's the country where the US currency was stronger or grew even more relative to those countries, which is exactly what the theory of purchasing power parity would tell us. Look at Japan, though. Japan had negative inflation, had deflation for many years. So a Japanese yen was therefore purchasing even more and more units of goods, including US dollars. And what did we see happen with its exchange rate? It actually strengthened relative to the dollar. Again, this is what purchasing power parity would predict. So although it's not a perfectly straight line, right? Exchange rates aren't always going to match up with what the purchasing power parity model would suggest. It does a pretty good job of explaining these exchange rate movements in the long run, at least, over periods of years and decades. Okay, do you guys have any questions then about that? So I know that's a bit more of a complicated topic, but the basic goal here was to try to understand what causes exchange rates to move around over time. The model that we're going to try to interpret the data with is this thing called purchasing power parity. And what does it say? It's based on the law of one price, that goods should cost the same across countries, right? So the amount of domestic currency you have should be able to purchase the same amount of the foreign good in a foreign currency after you convert your US dollars into foreign currency. The implication then is that what determines nominal exchange rates are these price differentials between the home country and a foreign country, right? So differences in the inflation rate then from one country to the next should help or go a long way to explaining why exchange rates move up or down. Let me close here by talking just very briefly about a couple of limitations to this theory, all right? Obviously, on the last slide, you see that not all of those blue squares line up in a perfectly linear way, okay? When you look at exchange rate data, it's very seldom will the actual data align perfectly with what the model predicts. There will be differences between the two. The extra credit exercise that hopefully many of you guys will do has a great illustration of that. Every 6 months, The Economist magazine comes out with this thing called the Big Mac Index, where you can figure out what the exchange rates are between the US and all these different countries using actual data on the price of a Big Mac in the US versus the price of that item in a whole list of different countries. All that data is in that Excel file on Blackboard. There's a couple of reasons why this particular theory is limited, all right, or a couple of drawbacks of the theory, if you will. One reason why the law of one price doesn't always apply in international markets is because many goods cannot easily be traded, okay? You might be able to buy coffee in America and sell it in Japan, okay? But a lot of goods, in particular, a lot of services, are what we call non-tradable, right? So we would not anticipate that people would be able to profit by buying non-tradable goods in one country and somehow supplying them in another, right? Haircuts, trips to the movie, tennis lessons, therapy hours, right? You can't purchase a tennis lesson in the United States and sell it in a foreign country. It is explicitly a non-tradable good, okay? So not everything we purchase, not all the services that we purchase are actually tradable. And so we would not expect then that price differentials from one country to the next would vanish, okay? And so that law of one price can't be applied to every single type of product that people purchase. That's one limitation to the theory. Another one that I think is quite important is something that I like to call a home bias, all right? Not every person views goods that are produced domestically to be perfect substitutes that are goods that are produced abroad, okay? Some people just like to purchase products that say made in the USA, all right? Or alternatively, some of you all might have preferences for a product that is produced in another country, right? Some people might like a BMW or a Mercedes over a comparable US-made car, okay? That's what's called a home bias or even a foreign bias. And so in that case, because the products aren't considered perfect substitutes, entrepreneurs would not be able to profit necessarily by buying the cheaper product and selling it in the more expensive market, okay? So this is another reason why the theory of purchasing power parity is limited. I think it does a fairly good job of explaining why exchange rates kind of adjust like they do in the long run. But if you look at month to month or week to week changes in the exchange rate, this theory of purchasing power parity is probably not a very good or useful model. If you guys go on to take some intermediate macroeconomics courses or an international finance course, if you become an econ major, you'll discuss another class of models that's more useful for thinking about business cycle changes in exchange rates. The theory of purchasing power parity is very much a long-run relationship. Okay. You guys have any questions then about that? I got a few more minutes if you want to. There's one more practice problem that we can do here. Which of the following statements about a country with a trade deficit is not true? So first of all, what does a trade deficit mean? Matt? Imports exceed exports, so net exports are negative. Can you guys take a look at A through D here and tell me which of these would not be true about a country that is running a trade deficit? So obviously it's not A, right? If exports are less than imports, then net exports are negative. And so that would be consistent with a country running a trade deficit. What about B? Net capital outflow less than 0. How does that relate to the trade deficit? Why? Okay, so what's the key concept here? Net capital outflow should be equal to what? Should be equal to net exports. Remember, that is a basic accounting identity. Whatever happens to the trade balance, there should be a corresponding adjustment in that country's net capital outflow. So if net capital outflow, Wyatt, is negative, that means a country's net exports have to be negative, which means it is indeed running a trade deficit. So B is also true. What about, let's skip to D. Is D true or not true, you think? If GDP is less than consumption, investment, and government spending? Matt? That's right, right? So GDP is the sum of 4 things: consumption, investment, government spending, and net exports. So if we're saying that GDP is less than C plus I plus G, that means net exports has to be a negative number, which means the country is indeed running a trade deficit, right? So the one that is not true would be C, okay? Now think about why. Net exports is the same as net capital outflow, right? And what do we know about the relationship between savings, investment, and net capital outflow? A country's national savings should be equal to net capital outflow plus investment, right? Therefore, net exports, which is the same as net capital outflow, should be savings minus domestic investment. So, if I told you that investment is less than national savings, then that means net capital outflow is a positive number. And so net exports are a positive number, which means the country is running a trade surplus, right? Not a deficit. So C is the one that is not true in this situation. All right, so maybe that one was a little tricky. Make sure you guys understand those relationships, okay? The equality between net exports and net capital outflow and what the definition of those two concepts are. How net capital outflow is related to GDP, consumption, investment, and government spending through the basic GDP accounting formula, that Y is equal to C plus I plus G plus net exports. One more. Or Matt, do you have a question? No. What if I told you that a Ford Escape sells for $24,000 in the United States and 720,000 rubles in Russia? If I ask you to tell me what would you predict the nominal exchange rate would be between the US dollar and the Russian ruble, how could you find that? Can you make that prediction based on the theory of purchasing power parity? What does PPP tell us the nominal exchange rate should be equal to? Matt? The foreign price divided by the domestic price, right? So in this case, 720,000 rubles divided by $24,000 or 30 rubles per dollar, okay? So if you see what foreign prices are and you see what domestic prices are, the theory of purchasing power parity makes a prediction about what the nominal exchange rate should be, okay? On that extra credit exercise where you guys will be looking at the data in that Excel file, you will be making predictions about what the nominal exchange rate should be according to the theory of purchasing power parity, then you can compare that prediction to what the actual nominal exchange rate is. And you can see the countries that are close to PPP with the US and some countries that are really far away, all right? And then I ask a menu of different questions about that information. Folks, that is all I have. Nothing more. You now know everything I know about macroeconomic principles. You guys have any final questions about this, about the test? Okay, I will see you guys on Thursday. I will try to grade the exams over the weekend and hopefully be able to post your final grades by, Thanksgiving week or as soon as the university will let me, okay? Good luck with end of the semester stuff.